discovered a man over in Loudoun County at Gilbert's Corner on Saturday who's a French baker, and he makes wonderful. He made a little tart, I'm having a little French tart, a little coconut tart.
Can you share it around our group?
I can, yeah, absolutely. Here, where do you want me to start?
Well, maybe for dessert at the. So, Chuck, we've got a large group here, and
looks like
why don't I just
36 people.
Right. You're a popular man, so I thought we would just have an interview / conversation followed by a Q&A.
Okay.
You know, our Wakefield students have a lot of homework, so I'll be quite diligent in attempting to keep it to 30 minutes so they can get back to their other studies and assignments.
They can do some real work, right?
Right. Maybe make some money.
Maybe make some money.
So Chuck, I thought I would start with just a little bit about yourself. Maybe you could tell us, how is it that you became interested in investing in business?
Absolutely, Paul. Well, thank you. I'm happy to be here, talk to the accumulated friends and students of Wakefield School. Thanks, Suzanne, for getting us involved as well. So we appreciate that. I grew up in Northern Virginia and was a student that the school systems hadn't really quite figured out how I learned and how it was different from other people. So I was a mediocre student, and I had a mediocre experience with my first college. And at any rate, when I finally finished college, I got out. I'd gone to college to be I was a pre-med student. I wanted to go to medical school. I think you have a brother who's at least one brother, Paul, who's a physician. That was my goal.
Actually,
and
too, but
I was confronted with organic chemistry, and I didn't study for it for a number of reasons, and so it was an effective barrier to keep me from going to medical school. I became an English major in comparative literature, and that's the degree I got when I graduated in the 60s. And when I got out of school, I really wasn't very well prepared to do anything. I went to New York and went through a battery of tests with a psychologist and so on. And he pointed me, because of our discussions and so on, in the direction of the stock market. And I came back to Washington, D.C. This was in the summer of 1968. And knocked on the door of every brokerage house in the city of Washington. And it was a boom time. It had been a boom time in the market. And most of those firms are long gone by now, but two firms offered me a job, and I ended up taking one of them. And so I was a stockbroker for 21 years at a firm that I joined in July of 1968 was called Johnston Lemon and Company. And when I joined them, it was the most important financial institution in Washington, D.C. It had raised the capital for Marriott and Geico and all of the drugstores and the utilities and that sort of stuff. And the world passed it by. As in my career there, it had a business that was so successful that it sort of didn't make much difference what happened in the market. And I say it in a constructive way because it gave me the opportunity to sort of follow my nose. And I took a great interest in understanding what made a good investment and what made a good investor. And I did that for 21 years. And I left that firm in 1989 and started my own firm with a literally a handful of clients and client assets, and opened my shop in Alexandria, Virginia, in Old Town, and above a bookstore, and watched what was going on in the market on a TV screen where I would read the newspaper to find out what was going on. I had one assistant, and so that's how I got an early start in the business.
Well, I've learned already we have something in common. My father's dream was that all three sons would become doctors, but he failed with me because I also was a somewhat uninspired student during my early years and ended up majoring in American literature rather than anything related to business. So let me ask you, do you think education or the subject matter of what you study in college really pertains much to how successful you can be as an investor?
I happen to personally think that having a liberal arts education is very valuable to become successful in the business world or financial world or lots of other endeavors. And the reason I say that is, it's what I had. People look at my resume and say pre-med and English major. What's that have to do with being in the market? I said, well, it's all the same. What are they talking? What are you talking about? They said, well, I said, in each of those disciplines, it's about gathering data points, gathering facts, and then making judgments about them. And that's what I do in the investment business. I gather facts, make judgments about them. And so the ability to do that and to think in ways that are not, strictly in a narrow channel that you might learn about the investment world in a business degree. So I would say, yes, making sure that you have a wide range of knowledge and information to become a better investor. And in my case, it continues to this day to be the pursuit of trying to understand how do I identify what's a really superior investment, an investment. And, it's not an overnight opportunity. It's an opportunity that takes place over years.
So it sounds like you would probably agree with an education that emphasizes critical thinking and also curiosity, because you have to be open to look.
I think curiosity is maybe the most important thing that you can have as a student of whatever you're doing, and critical thinking is just as important. So you're right on.
Right. So tell us a little.
I'll tell you a story about back in the 1970s, and I would go spend my summer in a kind of rural community in southern Maine, southwestern Maine. And nearby, about 10 or 15 miles away, there was an automobile race car track that was a dirt track. And over the years, the dirt track became a paved track, and they started building bleachers, and they instead of running over the people who had a wreck, they'd put them in an ambulance and take them to the hospital. All in all, the whole thing clearly was getting better. And I liked it. In the middle of the summer in the 70s, families were still having to use a blanket to keep warm at night. And the stands would fill up in the nights they had the races, and everybody was a cousin to somebody who was driving a car or next door neighbor or whatever. But I was curious about what was making that business so, grow and prosper, clearly prospering and so on. And I came back to my office in Virginia and in DC in those days, and there were basically some what they called industrial manuals, and I looked up all of the businesses that had racing, whether it was horse racing or dog racing or car racing or whatever, and because of curiosity, I began to study all of those businesses, and I ended up with a business that owned Daytona International Speedway, and ultimately, before I was through, 12 or 13 speedways, United States, and it absolutely terrific investment for many, many, many years. And it came about simply because of observation and curiosity.
Right. Right. You know, I think it's a fantastic trait to develop, especially at a young age. Let me ask you, Chuck, is there a point at which there must be a point at which you have satisfied your curiosity enough to pull the trigger and make the investment? How do you follow up from then forward? Do you reach a threshold that you cross where you're willing to trust the managers who actually own and operate the business in which you invest, or do you have constant surveillance of it?
Well, so first of all, I would just, if I heard you correctly, I would take exception to the fact that the managers own the business. The managers very frequently don't own the business, and very often only have a very small holding in it. In my investment career, simply for the ease of making an example, I pulled out an old milking stool that had been my father's that he'd gotten from somebody, and I decided to use that as a visual construct for what we believed in, and it's called the three-legged stool. Imagine that. And so each one of those legs stands for something, and what they stand for is that the first leg stands for the nature and the quality of the business opportunity itself, and it has to demonstrate that it has the ability to earn way above average returns on the capital employed. The second leg of the business has to do with the people who run it, and we're very keen on people who run the business having a significant personal, real investment in the business, that they're actually owners, and that they treat us as owners, partners, even though they don't know us in all likelihood. And then the third leg has to do with the ability of the management to take the free cash flow, the excess cash that the business generates, and reinvest it in a way that they earn these above average rates of return. And you get what we call the compounding machine. And you know, there's a recent book out that's been very successful that I'm a great fan of, called The Psychology of Money. And it's written by a man by the name of Morgan Housel. And in it, early in the book, he points out that the famous investor, Warren Buffett, has earned over 95% of his wealth after the age of 65. And that's nothing more than the effect of compounding at a high rate. So what you need to do is to figure out how you identify great investments and let them compound and go to work for you for 20 years, 30 years, 40 years, 50 years, or whatever.
Now, how is it that you do identify investments?
Well, so that's what we spend our time doing in my office. We have a very small office, and we have 3 partners, including myself, who work on ideas, and 2 more analysts, 3 more analysts who support us in our work. And we spend our time, typically the first thing we look for is identifying a business that has a way above average returns on the owner's capital. I'll give you an example. I usually ask an audience, what do you suppose the average net return on an American business is? And, you know, we'll get all kinds of responses, and I'll say the answer is in all likelihood that it's probably in the mid to upper single digits. It's 5, 6, 7%, something like that, typically. That's after tax. And then I'd say, well, do you have any idea what the return on investment, the return on revenues, or like that was, is on the credit card companies, MasterCard and Visa? And they'll say, well, you know, maybe it's 12 or 13%. I said, in fact, it's in the mid to high 30% range. This is compared to American businesses, most of whom have returns that are in single digits. They're having returns that are in the mid 30s, maybe the high 30s, net after taxes. And I said, among other things, you'd infer from that, 1, that they've got a big target on their back, because every business would like to have returns like that. And 2, they've got some very special secret sauce that's allowing them to earn those very high returns. And so we spend lots of time trying to figure out what it is that they're doing that makes that happen. We began our investment in MasterCard and Visa back in 2010 at a time when there was a lot of turmoil in Congress about credit card usage, and even they had something that became known as the Durbin Amendment. It relates to Congressman Dick Durbin from Illinois, and these businesses sold at really throwaway prices at 10, 11 times earnings, and growing at 25, 30% a year, and they're having returns on their capital that are in the upper 30s, and so they're generating way more cash than they could use, and so the reinvestment part of their story is a difficult thing to do. They can't find places to reinvest that money that do as well as they do themselves, and so that that's one of the three legs, the reinvestment piece. And so if we're able to find a business that gets high marks in all three of the legs, the business, the people, and the reinvestment, we call that investment nirvana. And then we say, and our discipline is we just don't want to pay too much. Paying too much, which is sort of I infer was part of what your question was, is how do you decide whether it's cheap enough to buy or so expensive that you ought to sell it? Number one is when we find really good ones, our experience has been, it's been a mistake to sell them even at very high valuations. You just live through it. And then at the first part, the atmosphere of the cost of money at large in the world affects the valuation you can pay. And so we're in an environment today where interest rates are, 1% or 0.5% or 10 or 20 basis points, or maybe a 1.5%. That means that you can pay a lot more for growth in that kind of environment than you can in an environment where interest rates are 8 or 10% or something of that nature. And you'll see it in housing prices. You could buy a lot more house or a lot bigger farm today in which rates were 1.5% or 2% than you could a decade ago when rates would have been 8% or something of that nature. It's just pure arithmetic. It's very simple.
Right. So Chuck, given your long history analyzing investments, how has that led you in decisions about how to operate your own firm?
So that's a good picture, and so good question. We have a partner in the business who is not involved in the investment side, has a master's in accounting, and has run another public company or another private company and sold it. And so we hired him originally to be our chief financial officer, and we subsequently made him chief compliance officer because our business has an enormous amount of regulation from the government, and our ability to be responsive to that, takes a lot of time. And then more recently, in the last couple of years, we've made him actually the chief operating officer of the business. And so, as he said, his job is to take everything off my desk except the investments. And so that's how we dealt with that. Having said that, I still have some involvement in the running of the firm, particularly from a point of view of what our standards and everything else like that are. And we have a slogan around the firm, which is we want to conduct ourselves in such a way as there are no questions about what we do. And
right. So I think one question our students might like to hear the answer to is as they approach their pending careers is what makes you decide to hire someone whose resume you see or who you interview, and what makes you decide not to do that?
So I have an experience of having made some great hires and having made some hires that stayed with us longer than they should have. Let's just put it that way. And it's remarkable that at least in one case, I had somebody working in the firm who it turned out after he left, we found out he was very abusive to some of the administrative staff in the firm in ways that I didn't ever see and they didn't tell me about, and didn't discover until after the fact. And for years we've said we have no openings, but we talk to a lot of people. In the last 2 years, we've actually made 2 hires that we went out looking for. And what we were looking for, we ended up being, in the terms of a headhunter, being described as a 2+2. And these were young people who did not have graduate degrees, had worked for 2 years at an investment bank, and then 2 years in the private equity field, and had no experience at all in the public markets. And we thought we could be very valuable in teaching them about the public markets, and we liked the disciplines that they had learned in both in the investment banking firm and in the private equity firm. They're being able to cover an enormous amount of ground, literature, information in a short period of time, and be able to put it to work in a spreadsheets or whatever else we want to have. And so our experience with hiring has been different. We've been, I suppose as time goes on, we get better at it than we have been. We're so small. We're 13 people in total, and we manage about $17 billion. And I have friends in the business where the firms manage $8 billion and they have 50 or 60 people doing that. And so we're highly efficient. We're very focused in what we do. We don't believe that we need to own the market or even look like the market. Our goal is to take our clients' capital and preserve it and compound it at a rate which is above average. And that's what we've done for over 30 years. And that's why we've been successful as we've been. It's just like the businesses that we look at to buy. Our own businesses, does our business have high returns on capital, and the way we run it does? Do we have people in the business who are owners of the business who treat us correctly and with respect and dignity and fairly? And do we have ways in which we can reinvest the excess cash we earn appropriately? And the answer is that we're sort of like the credit card companies. We can't find other businesses that do as well with the capital as we do in our basic business. So we end up with a lot of extra cash flow.
So Chuck, we've got a few minutes here. I thought I would take the opportunity to quote some of the icons in the business, some of which I suspect you may know, and all of which I suspect you have heard of, and get your reaction to some of the sayings that I collected from them earlier this afternoon. The first one is probably the best known, from Warren Buffett, quote, "Be greedy when others are fearful. Be fearful when others are greedy." What's your reaction?
Well, it makes perfect sense. I've been going to the Berkshire Hathaway annual meeting since the early 1980s. That means I've probably gone 35 or 36 times. I've missed maybe 2 or 3 possibly in that period. And I'm a great fan of both Warren Buffett and Charlie Munger because they're obviously brilliant. They're very clear thinkers, and they express themselves in very clear ways. And the notion that he's talked about a lot and makes total sense is that, there in the world at large, if you wanted to go buy a car and it was $30,000, and for a number of circumstances, all of a sudden, a week later, you could buy that same car for $24,000, you'd realize that was a bargain, and you'd be inclined to act. In the stock market, very often the exact opposite happens. If the stock is $30 a share and it goes up to 35, you say, "Oh my God, I better get into it. It's really doing well." But if it goes down to 25 from 30, you say, "Oh, there must be something wrong. I I shouldn't buy it. And that's exact opposite of what you do ordinarily in your life. And so if you understand well what it is you own, and that's a really important idea, then if it goes down 50%, you sort of go all in, you add capital to it. So that's being opportunistic when the world is fearful, and being fearful when it's opportunistic, right?
Okay, here's my next one from John Templeton, the Templeton Funds. Quote, "The four most dangerous words in investing are," quote, "this time it's different," end quote.
Right. So John Templeton ended up, as a British citizen. He lived in Nassau, in Lyford Key, grew up in Tennessee, and he was famous for early in his investment career, when the market had a great decline. He called up his broker and said, "Buy me 100 shares of every stock that's selling for $1 or less on the exchange." And this was a time when they did that. And so, he was behaving against the flow, against the tide, and which is a reflection of what he's talking about in that quote. It's different this time. Oh, I'll be able to get it done because now things are different. And he's just saying that history, if it doesn't repeat itself, it rhymes. And it's valuable in that regard.
Here's one from John Neff. Quote, "It's not always easy to do what's not popular, but that's where you make your money."
So there's an old Wall Street expression which says, "A company well bought is half sold," and so we one of my partners is actually named John Neff, and we joke about when he showed up for work. I said, "Oh, you're the wrong John Neff, because the one you referred to was a famous value investor in the 70s and 80s, and so he's talking about the same thing about being greedy when others are fearful and so on. I mean, doing what's not popular. In our firm, we first of all, back up and just say, I happen to personally believe that everything around the market is really driven by the activities of people trying to create transactions. That's what they do for a living, whether they're investment bankers trying to buy or sell a company, or stockbrokers, suggesting a trade to you. That's what they do. And we don't do that. We actually, on our website, you'd find a white paper called "The Art of Not Selling," and it's very hard to do. And that's a good place where it's hard to do. It's hard to do the unconventional, and that is, people think if you bought it at 20 and it's now 40, you ought to sell it. If you think that it's a great business and can compound at a high rate, then the thing you shouldn't do is sell it. You should hang on and let Uncle Sam, with his uncollected taxes on your gains, be your partner and carry on for years. So, yeah.
This isn't a quote, but it's a story of how Ace Greenberg used to manage Bear Stearns. And that is, if a trader did not show enough losses, he would fire that trader because the trader was not taking enough risk.
Well, the same story is true about bankers and about bankers. And they said, if an agent in the bank doesn't have enough losses in his portfolio, he hasn't taken enough risk. And so, there's people who believe that. We all end up having losses and things. It's just a fact of life. I don't know of anybody who's been able to do it perfectly forever. And so, learning how to learn the lesson from the losses, it should not be because your thought process was wrong. It should be because things went on outside of your control entirely.
Right. My last quote before I turn it open to any questions, and I have several questions already in the queue, really relates to where you think the market valuations are at present. And I quote Herbert Stein's principle, "What can't go on forever must stop."
Well, he was a smart man, wasn't he? So
Oh,
I'll start.
they all are.
I'll start first by saying that there's nothing in our record that suggests we have any skill at predicting where the market's going. So we don't try. And we think it's part of the con game of Wall Street, is, if you'll allow me to say that, to suggest that you ought to be reacting to the market. Reacting to the market, I think, is bad for your economic health. And certainly everybody that you know has periods of times where they think they get a hunch and it turns out they make a lot of money on it and so on. Just to the experience that's going on in GameStop right now. There's so many, all I say to people is, I think that's great. Just make sure you understand exactly that what you're doing is gambling. And if you're gambling, then that means you have to be prepared that you're going to lose all the money. And certainly plenty of people have in that whole episodes around GameStop. As it relates to the market generally, it's clearly a much higher valuation than it was 10 or 12 years ago. But at the same time, as we spoke earlier, interest rates are much lower than they were 10 or 12 years ago. And so that in and of itself provides the opportunity to pay more for businesses because of that thing. The other piece is that in doing the valuation of a business, and our valuation work relates to the price you have to pay against the free cash flow that the company generates. And that's a whole nother chapter. But if you are looking at the world, in today's world, and the rate at which things are changing, many companies these days fall into the category of what we call asset-light businesses. That is, they have less capital invested to make their returns happen, and are growing at astronomical rates. And the question you obviously ask is, do they have the ability to do that for a long period of time, or is the next competitor going to show up and ruin their business model? And we've seen lots of those in the last decade. So I would say to you, one, the valuations of the market are much higher than they were a decade ago. Are they outrageously high? We find plenty of things to do in this environment, and if you're diligent about what you understand, and I think you can find things in this market to pay the price, and as they say, pays your money and takes your chances.
All right. Okay, we're a little over 30 minutes. I've got a couple of questions here submitted in advance, and if anybody wants to submit, we can go over a few minutes, but via chat. Okay. The first question is a great question. It's a generalist question, and it is, quote, I'm interested in what the top 1 or 2 books Mr. Akre would recommending reading in general.
Well, I read a lot, and I read a lot of business biography. And I think from a pure common sense, great advice point of view, the book I talked about earlier, The Psychology of Money by Morgan Housel, which is a pretty new book, the last few months, is a great read. It's a very easy read. You can put it down after a half hour a lot of times, and I think people would get a lot. They'd learn a lot from it. I learned a lot from it. I've read it a couple times already, and so that would be one thing. What else would be a great general read? I think any kind of great business biography is worthwhile. Right now, I'm reading quite a few books at one time, and one of them has to do with the history of the Vanderbilt family, and Cornelius Vanderbilt at one time was the richest man in the world, and some years ago there was a family reunion in which all the 23 or 24 members there wasn't a single millionaire in the group, and so it's the business of fortunes being built and fortunes being dissipated and that sort of stuff. So any business biography is a great read. And as I say, Morgan Housel's book, I'll probably think of 3 or 4 more things after we're off the air.
Right. Funny you mentioned that. I'm in the middle of Arthur Blank's business biography called
There you
Good
go. I mean,
Company.
so he founder of Home Depot, co-founder of it.
Right, right. This is a question I'm sure you've had before. With all the federally enacted stimulus money being pumped into the economy, what's your view on inflation rearing its ugly head at the end of this year or soon thereafter?
Well, so we've been in a 40-year secular decline in interest rates, and it was in January of 1981 that the 30-year U.S. Treasury bond hit 15 3/8%, and prime rate was 21 or 22, and today it's in the secular decline basis, it's been coming down for 40 years. For 20 of those years, I've been absolutely dead wrong about the direction of interest rates. I've thought, well, they've got nowhere to go but up. And of course, in a letter that I wrote to partners just over the weekend, I said, I read in the paper just this past week about a lady in Europe borrowing $400,000 from a bank to buy a house. And then within the first month, the bank started paying her interest. I mean, so things are really topsy-turvy in this world. I continue to have this notion, having lived through it, particularly in the 70s, as we had rapidly rising interest rates and inflation, that at some point we'll have a significant inflation, because it's one of the ways that governments end up being able to pay off all their debt, by devaluing the currency. And so if you have a 8% inflation, you're really devaluing your currency at that rate on a per annum basis. And so the dollars they pay their debts back with are worth less than the dollars they borrowed. So I think that at some point in time, rates will rise. Chairman Powell on Sunday in an interview at 60 Minutes said, our target is 2% on interest rates, and it's on average. That means we will absolutely not raise rates until we're at a point where inflation is at 2% on average, which means it probably is running at 3% at that point in time. I have no crystal ball about it. I'm just saying this is my visceral experience, and I can remember that what happened in those days in the 70s was that inflation got built into every wage contract and every building lease that you could think of, and they all went up by GPI every year, and sometimes they didn't have any limits on how much they could go up and that sort of stuff. And so it's scary when that happens, but we're not facing that right now, but we might,
The third question is also a frequently asked question, and that is, what is all this cryptocurrency? Are you an investor in it? Does it have a future?
Well, so I brought home 4 articles from a paper on Monday to read about Bitcoin. I heard on the news this afternoon that it hit like $64,000 of Bitcoin. I had somebody who gave me a couple Bitcoins when they were brand new. I have no idea how to retrieve them. And the thing that I don't understand about the quote cryptocurrencies is the fact that there's nothing behind them. There's no backing. That you may not like the American dollar, but it has the full taxing authority of the United States government behind it. And so what they can't pay off, they can go out and raise taxes and get more money to pay off. And none of the cryptocurrencies have that backing behind them. So my whole goal some years ago was to not put myself in a position where I'd wake up one day and say, oh, that's what it was about. I haven't really figured out what it's about, but I keep reading and keep seeing if I can figure it out. So I don't know. And if you know it, you should tell me.
I'm in your same boat. It's a total enigma to me, and I'd rather spend my time figuring out hard assets. Chuck, let me close by asking if you could give our students a couple of quick thoughts on what to think about in their their high school years, their education. We emphasize very much through our curriculum the critical thinking aspects of it, and also the writing and good grammar and literature and the like. And I'm sure they would love to hear a few quick thoughts from you on how to approach their high school years and beyond.
So I sent to you today a piece put together by one of my partners about students and working to get a job in the investment business and what they should do and what people are looking for. And I would just say it doesn't relate specifically to our business, but my partner said, among other things, he starts off by saying grades matter. And so when we're looking to hire somebody, we want to see that they they've shown that they can do the work handily, that there's no questions about that. And the best way to see that is, to have really good grades. And this partner of mine, I think I told you today, Paul, is a fellow who went to Tufts, and he never, through his junior year, he'd never had anything but an A, ever. And even so much so that he doubled up on his courses so that he graduated in 7 semesters instead of 8, because he was fearful that he might loosen up his senior year spring term. Well, that's not an experience that I've ever had, and I almost can't even identify with it. But it's a really solid notion that whatever you pursue, pursue what you love to do and do well. And the only way you find out about that for the most part is experimenting. And so your high school and your college curriculums give you a chance to stick your toe in a lot of different kinds of water and figure out what makes sense to you. It turned out that as a stockbroker, as I was for 21 years, I earned my living basically on commissions. And quite frankly, I didn't particularly enjoy that. But what I found out in the process was that I really enjoyed the digging in and finding out how companies worked. And then later on discovering that for me, the successful thing to do was to focus on those businesses that had, way better than returns on average. And so I think I got off track a little bit there. Steer me back in the right direction.
Right. Well, I think the message is the importance of excelling in what you do and being diligent and curious about a lot of different things is a good route to finding a good future for yourself.
Absolutely.
And a good future for yourself is something that you enjoy.
Absolutely.
We had a seminar a couple of weeks ago from a friend of mine, and I would just repeat his saying: if you love what you do, you've never worked a day in your life.
Right. And so do what you love to do and what you do well, and avoid the things that you don't do well and you don't like to do.
Right. And understand that future employers are going to look very carefully, not only at your grades, but how you present yourself, how you write, how you speak.
That was one other question you asked me about. And I can tell you that over the years, I've had people who were educated at some of the finest schools in the country who, in my mind, couldn't write a sentence. And in the investment business, for example, as it would be in lots of other things, you can have the best thought process in the world of being able to identify investments. But if you work in an environment where you have other people's money to put to work, it does you no good unless you can convey the thought to somebody else. In my case, any of my partners, anybody comes up with an idea, it may be a great idea, but if they can't articulate it well to us, then it doesn't have any value. And so yesterday we had a meeting, 5 of us, about a new issue we were considering studying, and and they'd start to describe it, and then they'd go down these rabbit holes. And I kept saying, no, I want to understand what the essence of this business is. I want to understand. So I want them to be able, sometimes they'll write a report that's 20 pages long. Then we make them write a report that's 1 page. And then on top of that, we want to be able to take that 1 page and turn it into just 1 paragraph. And so that's the issue of critical thinking and being able to write. And that's really important.
Right. I would just conclude on one other theme that you articulated in your responses as well, and that is it's really important to operate your business and run your life according to a set of values.
Amen.
Because they're the spine of what you're about. They represent the future. They're the guideposts whenever you're confused.
Right.
Chuck, thank you so much for your time. I know we're well past our time allotment, but it's been enormously interesting and worthwhile. And thank you for your availability and your support of our school.
Well, happy to do it and enjoyed it, and don't hesitate to call on me again.
We will.
Okay.
And hopefully sometime it'll be in person.
I give you is that partner of mine who had all the straight A's, he also won a couple debating contests along his way in high school and that sort of stuff. And so again, the ability to think, be able to take either side, articulate a point of view and that sort of stuff, very valuable.
Right. All right. Thank you so much.
Thanks.
Bye-bye.
Bye.
Thank you. Great.